We have three very important things to get into here in this video. Number one, some breaking news. Ford is no longer going to compete with Tesla, canceling their plans to invest about $12 billion into their EV business. Yeah, this is great news for Tesla and could be part of why Tesla's stock is up 1% here in after hours. Number two, Janet Yellen, the Treasury Secretary, she used to be in Fed Jerome Powell's position, the head of the central bank. She just dropped a massive bombshell. And we have that for you in this video as well. Number three, last but not least, we have big economic data coming out tomorrow morning that will give us a specific look at the consumer. So we have a lot to get into in a very short amount of time. Hit the like button if you own Tesla stock, if you're an investor in Tesla stock, or you just want to make more money, as well as subscribe to the channel. If this is your first time here, consider sticking around a while. After these videos, you will be a more educated, a wiser investor and or trader. Remember, the best prescription for your complication is a subscription to the channel. Hopefully we can get those portfolios looking right here in the next couple of months, and I have a feeling that's exactly what's about to happen. So let's start this video off with a little good news for Tesla. I also want to look at the option activity today because it was another huge day for Tesla options. So this article says Ford will postpone about $12 billion in EV investments as buyers become more cautious. Ford said customers in North America are unwilling to pay a premium for an EV. The company in turn is postponing about $12 billion in EV manufacturing investments. Ford's Model E EV unit lost $3.1 billion through the first 3 quarters of this year. A couple different things to point out. This is $12 billion in EV manufacturing. This is time wasted. If you are someone preparing to capture the next generation of EV sales, to be a pioneer and a leader in this field, you have to do what Tesla's doing. You have to be aggressive to get there. The adoption wave has started for EVs. This is Ford basically saying, we cannot afford to compete with Tesla. We're going to sell our F-150s. We're going to sell whatever models people want to buy, but we're just not expecting much demand from this. And eventually it's going to be one of those scenarios where Ford's going to get left behind. Not just Ford, GM as well. GM just canceled their plans to jointly manufacture EV vehicles and try to, quote, compete with Tesla. In that partnership with Honda for $5 billion, they just announced that on their earnings. It's due to the UAW strike. This is really putting Tesla in a position where they're not going to have much competition on their lower end EVs. So sure, if you're someone that is looking to spend 60, 70, 80,000 to buy yourself an F-150 truck, sure, you have that option, or you could buy yourself a Cybertruck for roughly the same price. But if you're someone that's in the market to buy an EV vehicle, that you want good tech, you want good value, you want something cheap, well, Tesla's really your only decent alternative right now to an internal combustion engine. And it's looking like it's going to stay that way for a while. This could be part of the reason why Tesla stock is up 1% here in after hours. But it looks like things were not all peaches and roses, as I like to say, in Tesla options today. You see 956 orders totaling $1.81 billion with a positive order value of 15%. There was not a lot of bullish trades placed on Tesla today, and at one point the VIX was up almost 8%. There was a lot of fear out there until you kind of got that bounce towards the end of the day. You got the sell-off again. The VIX ended up closing way down compared to where it was at the highs. So there was a little bit more panic here today in the markets. That does make sense to why you've seen a little bit more of that bearish option activity. I should say a lot more of that bearish option activity in Tesla stock today. Now, Janet Yellen just dropped a bombshell as well. If you guys don't know who Janet Yellen is, she used to be in Fed Jerome Powell's job back before he was elected as the chair of the Federal Reserve. Like 2012 to 2016, I believe, was her tenure at the Fed. She is currently the Treasury Secretary of the U.S. That means she handles basically the bank account of the U.S. government, issues bonds, things of that nature. Now, take a listen to what she just said about longer-term interest rates.
So we were just talking about Americans' perception of the economy, but another thing we follow closely here at Bloomberg globally is investors' perception of the economy. So I want to ask you a little bit about the rise in yields that we've seen. We've seen yields surging over the last few weeks. The 10-year Treasury rose above 5% earlier this week. What's your view on what is driving that surge in yields, and how much of it is connected to investors' concerns about the U.S. deficit?
Well, I don't think much of it is connected to that. This is a global phenomenon in advanced countries. We're seeing yields go up in most advanced countries of the world. And largely, I think it's a reflection of the resilience that people are seeing in the U.S. economy, that we're not having a recession, that consumer spending and demand continue to be strong. The economy is continuing to show tremendous robustness, and that suggests that interest rates are likely to stay higher for longer. And so part of the increase in yields, I think, is simply a reflection of the strength of the economy, the notion that interest rates will be higher for longer. Now, whether or not that's really true, if we look at 5 or 10 years, what are interest rates likely to do? Honestly, for a very long time, we've felt that interest rates over decades had been coming down, real interest rates, and that there were deep structural reasons for that, in part relating to demographics. And those underlying trends, they're still there. They're still in force. So I think it's perfectly possible that we will see longer-term yields come down, but nobody really knows for sure. But I see the higher yields as certainly, importantly, a reflection of a stronger economy.
Janet Yellen just said in English, don't assume that rates are going to be higher for longer or higher forever, as the markets have really been saying due to the rise in the 30-year Treasury, the rise in the 20, as well as the 10-year Treasury. She says there are structural dynamics at play in the economy that are probably going to keep rates really, really low into the future. A couple of those things would be the ever-rising average population of the U.S. Now, besides like immigration, people are getting older, and they will get older over the next 10 years or so. And people, when you get older, you tend to spend less money. You tend to make less money on the average. I mean, a lot of you guys probably are in better positions than the average person. Maybe you're more capable of spending more money, but you probably don't spend more money compared to the average person. You probably spend less than the average person. But nonetheless, that's a longer term trend that is having a role to play. Also, innovation. As you can probably already tell, everything around you basically gets cheaper over time, especially like electronics, your goods. Your TV that used to cost thousands of dollars when they first came out, now you can get a 50-inch flat screen for $300. I mean, that is very deflationary. You also have globalization. She goes on to say in this speech, or really conversation, it was like 35 minutes long, so obviously we're not going to play the whole thing. I do recommend you guys watch it. It's Bloomberg. Just type Janet Yellen speech today, Bloomberg. You'll find it. Listen to the whole thing. It's like 35 minutes long. She goes on to talk about this globalization that, you know, was out there, meaning that, like, for an example, if you're Tesla, maybe you sell vehicles in the US, but you get battery materials in India or China for way cheaper. Well, that's going to make your product a lot cheaper in the US, right? Sourcing labor to other countries like an Apple does. That makes your products cheaper, while also helps out that other country. She goes on to say there's a lot of areas in which the US and China can have a mutual agreement, kind of mutual economic interest in globalization instead of deglobalization. We've seen globalization for the past 50 years or so. If that comes back and we can see more cooperation with countries to, work together, well, that's going to be another driving factor to drive inflation down, to keep inflation down, to keep interest rates lower. All of these things, and there's obviously more, but those are some of the big ones that come to my head right off the top, are big factors in why she thinks interest rates are going back down to essentially where they were. Now, again, Janet Yellen says some outrageous things just back in March, February. The banking crisis is sound and resilient, and boom, they're dropping like flies. So take it with a grain of salt, but when you see the Treasury Secretary saying this, I mean, it's something the markets pay attention to. And at the same exact time this was actually said live today, the markets started to rally. So I also think that could have a role to play in our markets going ahead. But something happened today. So did anyone notice today the NASDAQ was down almost 2% and your small cap stocks represented in the Russell 2000? Well, they were up almost half of 1% today. We got very strong economic data this morning. A strong GDP report, a strong durable goods order report. Like way too strong. And what did treasuries do? Well, yields fell. That means investors bought the bonds, and your big tech stocks got sold off. Now, I want to explain this in the simplest, easiest way for everyone to understand it. Who benefits when rates go higher? On a corporate level, on the market side, what companies benefit? Well, it's companies that don't need to raise capital. It's companies that have a lot of cash on their balance sheet. Okay, so that is Apple, that is Microsoft, that is Meta, that is even Nvidia to a certain degree. They do make a lot of money and have a lot of cash. That is Google, that is Amazon, that is basically every company that has done well over the past 18 months, year or so. And why do they benefit? Well, people don't stop buying iPhones, right? It doesn't hurt Apple when the Fed raises rates. People or businesses do not decide to get Microsoft Cloud services based on what the Fed is doing. People don't dictate their advertising off of the Fed in reference to Google's business. People don't opt to buy that GPU from Nvidia whether or not the Fed raises rates. It has virtually no impact to their business. But yet, their cash on their balance sheet now pays them a whole heck of a lot more money in interest. So that means they're making billions of dollars every quarter, basically free net to the bottom line just because they have a lot of cash in the bank. Now, when the Fed raises rates, who gets hurt the most? Well, a company like Tesla obviously does not benefit when 90% of individuals buy vehicles through financing. It's made Teslas, cars, in general, houses unaffordable. So Tesla has been a big loser of this, even though Tesla is making like, what is it, 300, 400 million a quarter or so in just their net interest capital on their, $26 now billion in cash. So Tesla is benefiting a little bit, but the net drag on Tesla's business is way larger than the couple hundred million they're making in net interest. Your small cap companies also get hurt when the Fed raises rates because then they're unable to refinance their debt. When their maturities come, a lot of them are not going to be able to pay them off. A lot of your zombie companies, I know you guys have heard that word before, for a lot of reasons. It's bad for small cap stocks and stocks or companies that need financing, but it's good for big tech. Now, what happened today? Big tech sold all the way off. I mean, it was bad out there on Wall Street. Microsoft down almost 4%. Meta down almost 4%. Apple down, almost 3%. The list goes on and on and on. Google, Amazon in regular trading, all of those stocks were down. But your small cap stocks were green. And again, we got really good economic data. This means investors are taking that money out of big tech. They're putting it into small cap companies. Because if you really do see a soft landing and there is no recession, or at the very least, there's not a big recession, small cap companies are way too beaten up. Way too beaten up. That's where the money's to be made. It's not in a Microsoft or an Apple. Think about it like this. If the next move for the Fed is rate cuts, well, don't you think it makes sense for investors to position for that now if it's coming in the next 6 months or so, rather than Apple or Microsoft, these other big tech names? They're not going to benefit from the Fed lowering rates. That might hurt their numbers, because then they'll get less in that, that percentage of interest they're making off their cash. So the only companies that stand to benefit are your small cap companies. A company like Tesla as well. So based on what we're seeing, if this does continue another day or two, I think you're going to have a solid trend on your hands where capital is flowing out of big tech into areas of the markets that are going to benefit from Fed policy in 2024. And I think today might have been the first day for this. Now, I could be wrong. One day does not make a trend, but it was very obvious what happened today. Because after all, what has the trend been lately? When bond yields go down, stocks go higher. Okay, bond yields fell big time today. 10-year treasuries, 30-year treasuries, down to between 10 and 12 basis points. That's as to be expected. So your small cap stocks did exactly what you would think they would. But your big tech stocks got absolutely hammered. Now, in theory, the data we got this morning was way too strong. The market should have said higher for longer for Fed policy. And they didn't. They said soft landing. And I agree with that to a certain extent. I don't know if there's going to be a recession. I still think there will be a slowdown. Does the government categorize us in a recession or not? I don't know. Are small cap stocks already trading as if we are in a recession? Yes. So I think there will be more downside for the broader indexes, but not as much of that downside for the small cap stocks. I think the next couple of weeks are pretty troublesome for the SPY, for the QQQ. If you own the broader indexes, you're probably not going to do nearly as well as if you owned an eco-weighted ETF of the S&P or the NASDAQ, or if you owned high-quality, small mid-cap stocks. I think you're starting to see a change of trend, but again, one day is too soon to make that conclusion, but all of the right signs are pointing towards this. And Tesla, again, it's going to be a huge beneficiary of rates coming down in 2024 and avoiding a recession if that is the ultimate outcome. And investors will realize this. Investors will buy Tesla stock hand over fist once we realize rates are coming down and no recession. Again, if that is the ultimate outcome, which right now the data supports it. Now, tomorrow you are going to get some very important data as well, specifically with inflation and the consumer. So your core PCE, you're expecting 0.3%. Last month's reading was 0.1%. So you have pretty high expectations for core PCE. I think there's a good likelihood it comes in at 0.2%. That would be bullish for markets. That would, again, reinforce that soft landing. Inflation's continuing to come down because 0.2% on a 12-month annualized basis is 2.4%, right? at 0.3%, that is 3.6%. On a core basis, you don't really want to see 3.6% annualized. Again, 0.3%. 0.2% is a lot better. And if you come in at 0.1%, you are going to get an epic rally in the markets tomorrow. Now, what I think is equally as important is personal spending. Personal spending is expected to come in at 0.5%. If it comes in hotter than that, that might actually be good for our markets. People have been under this, notion that if spending is high, inflation is going to be high, or if income is high, inflation is going to be high. Not necessarily. We've seen good spending data for like 20 years, and we did not see inflation. We struggled to get to 2% inflation most years. As long as your inflation report comes in low, spending comes in high, that's again supporting your soft landing. Now, personal spending is going to be particularly important because about 70% of your GDP is personal consumption, right? Personal spending. Now, some of these numbers that we just got on GDP don't look as good under the surface. Again, 70% of your data is around personal spending. But some of the other numbers were really helping out this number here, right? It says consumer spending rose 4%, the most since Q4 2021. So that definitely helped. Led by consumption of housing and utilities, healthcare, financial services, and insurance. Food services and accommodations and non-durable goods led by prescription drugs, recreational goods, and vehicles. Exports soared 6.2%, rebounding from a 9.3% fall in Q2, and imports also increased 5.7%. versus negative 7.6% last quarter. Private inventories added 1.32 percentage points to growth. So if you take out some of these other things, your GDP report wouldn't have looked so good. Now, this is backwards looking. This is data from, July, August, September. Personal spending, you really want to see how that comes out. This is going to be, again, let's confirm this. This is for September. So we'll get a clearer number of how the end of the quarter was looking as far as personal spending. And that will be important for markets. I don't think it's going to be as important as, obviously, core PCE. Now, if you guys did not see, Amazon did pretty good following their earnings. You had like 13% revenue growth, basically a beat all across the board. Amazon's up 5% in after hours, one of the better earnings that we have seen. And this is helping out your mega cap stocks, your some of the leaders you've seen in the markets. But notice here, even Apple is down 0.14%. I am notably bearish on Apple right now heading into their earnings. I think that could be a disaster. But overall, Amazon earnings may have bought the indexes a little bit more time. Like I said in the last video, if you look at the RSI, which is down here, normally when you get to about 30, you almost always see a bounce. To reset that RSI, give it a chance to go back up, and then you'll get further downside from there. And that's basically what I'm expecting to happen. The RSI is at 32.20 until something else negative happens, or until we get the Fed next week or Apple next week. You're probably going to see a sideways market, if not a little bit of a bounce. I don't think you're out of the woods on the index basis. I do think small mid-cap stocks are looking a lot better after today. Same thing with the SPY, which tracks the S&P 500. You are at 30.53, which is right on that oversold line. You're likely to get a bounce here. So really, just to put my final thoughts on this, what we heard from Janet Yellen, wow, I did not expect that. She basically said we're going back to low interest rates, give it some time. That's something you want to position for over the next, whether it's 6 months or whether it's 6 years. You want to position for it. I do think there's going to be more downside. In my mind, again, I'm not a financial advisor, I'm not a fortune teller, I don't have a crystal ball. I would be 100% shocked if big tech does not fall, meaning that your index is going to fall. But your other stocks, your stocks that have not done well over the past 18 months, are probably going to start recovering as investors look forward to the next move in Fed policy, which is going to be rate cuts. Unless we get, again, crazy high inflation data, probably going to get rate cuts. As we've seen today, the markets really liked, let's be honest, the markets really liked the good data we got today. Bond yields fell. Big tech fell because money is moving out of big tech. If you look at your QQQ, your SPY, you would say today was a terrible day. And it was if you are an index-based investor. If you are in your big tech stocks that have done well. Money is leaving the safety trade, heading into the risky trade today. That is what I would call, by definition, a pretty strong day. Your risk on assets performing well is not exactly that fear move. Again, gold was up a little bit today. Certain things are still a little wonky out there. So again, one day does not make a trend. But if I were to, use my common sense here, investors are forward looking. We're looking forward to rate cuts. When you sit here and say, who's going to benefit when the Fed lowers rates? It's definitely the parts of the market that did exceptionally well today. Again, small mid-cap stocks. I believe that's a Tesla. Tesla gets grouped into big tech, even though it's still down 50% from all-time highs and is going to be a huge beneficiary of rates coming down. It's still grouped in that category. But it's one of those situations where when you get this trend starting, investors are going to realize probably pretty instantaneously, oh, wait, Tesla's going to benefit from this as well. So Tesla will have its day, but Tesla might be grouped into the camp of big tech. The broader indexes, as they continue to fall, Tesla's probably going to be grouped in there as well. Who knows? I could be wrong, but this is how I'm positioning my portfolio, is in those small mid-cap stocks, quality names, okay? I own Tesla. I own Fubo. I own SoFi. I own DraftKings. I own, what else do I own? I own Snapchat. Their IR team needs to be fired. I own AbbVie. That's not exactly a small cap stock, but nonetheless, those are the stocks that I'm positioning in right now. A Crocs, which is trading at an 8 PE, that's growing 35%. I'll take that any day. In your small mid-cap stocks, that's where I want to be right now. And Tesla, especially Tesla. At these prices, if we fall even more. So that is going to go ahead and do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Again, if you guys would like to come trade with me, get notified every single time I make a trade, link down below in the description of this video. You guys enjoy the rest of your day and night. My name is Michael Tyler, and I will see you in the next one.